Welcome, everyone. My name is Rebecca Riley. I'm Director of the Economic Statistics Centre of Excellence, ESCoE, here at King's Business School, King's College, London. And I'm delighted that we have here today to talk to us Professor Jonathan Haskel, external member of the bank's Monetary Policy Committee. As you will know, alongside Jonathan's MPC role and before, Jonathan has also contributed immensely to the development of the field of economic measurement. His ideas on the measurement of productivity and intangibles are published widely in academic journals and in books. He was also for many years a non-executive director on the board of the UK Statistics Authority. So it's absolutely fantastic to have you here. And this will be Jonathan's last speech as a member of the MPC after 6 years that have been characterized by a raft of significant economic shocks, including the pandemic, of course, and during which policymaking can't have been plain sailing. So we look forward to hearing your reflections on what these events have meant for inflation and monetary policy, as well as the challenges of setting policy in real time. Please note, everyone, that there will be an opportunity to ask questions of Jonathan after his talk. Jonathan, the floor is yours.
Thank you very much indeed, Rebecca, for that very kind introduction. And I'm delighted to be here and see so many old friends from when I first started on this committee and new friends that I've made over the time that I've been here. So what do I want to talk about today? Let me press this button and hope that that works. There we go. I've got 5 things which I want to say something about. Firstly, some questions about inflation and uncertainty and the future. Secondly, I'll walk you through a model. Not everybody here is an economist, so I'm going to have to do a bit of a sales job to tell you why it is that economists like models. Accounting for past inflation using the model. As Rebecca kindly said, I want to say a little bit about real-time policy making under uncertainty and something about the prospects for inflation. Okay, so let me start with some questions then for inflation and for uncertainty and the future. I'm going to have 4 questions, and here they are. Firstly, controversial question, what caused the pandemic era inflation? So inflation went up to a remarkably high level over the course of the pandemic. What caused it? Of course, there are lots of different hypotheses on the table. One hypothesis is a series of economic shocks hit the economy, and that was an unfortunate sequence of events, and that caused inflation. The other hypothesis is there was too much demand for too long, or other versions of that, which are essentially that the Bank of England was asleep at the wheel. I'm going to give you some answers as well, so you get your money's worth on this talk. You know, don't not only get the questions, but you try and get some answers. You'll not be surprised to know that I have an answer to the first question, which is that it was external shocks. But I'm going to try to justify that answer. I mean, I would say that, wouldn't I, right? But I'm going to try to justify that answer and take you through the logic behind all of that. And I hope that will show how it is that economists use models to attempt to interpret the data in front of us. Second question is, why were the 1970s so different? What's interesting about the 1970s is there were similar energy price shocks in the 1970s, although interestingly, they were much smaller actually than the energy price shocks. We've had mostly oil price shocks. We've had similar quantity oil price shocks, but then natural gas price shocks have been much higher. So they were rather smaller, but inflation persisted for much longer. And so I think an interesting question is, why were the 1970s so different to the current era? Here's the answer, which is that we think on the basis of the model, the 1970s had more flexible labour markets and better anchored expectations. Finally, third question, as Rebecca mentioned, how do you make policy in real time? And of course, there's loads of data uncertainty, and it's always very easy to make policy with hindsight. So I just wanted to introduce you to a little bit of a case study around the data in the labour market, just to give you some insight into how it is that we actually make decisions. I know King's College, Rebecca mentioned the ESCoE, but King's College have got a very powerful kind of research area in public policy. So I'm hoping that this might be of interest to public policy, people interested in public policy and generally, as a kind of example of trying to put public policy into practice in the light, especially of all the various things around data and so forth. Finally, something about future prospects. Two things on future prospects. Firstly, about interest rates. So there'll be a portion of the audience who are particularly interested in the immediate term about interest rates. So let me get that on the table straight away. And this is a quote from the paper that was released earlier on. My preference, and I'll try and justify this, is that I would rather hold rates until there's more certainty that the underlying inflationary pressures have subsided sustainably. So I'll try to justify that statement and why I believe that. But finally, I'm going to say something about bank credibility. Since this is my last speech, I get the chance to actually look back over the last 6 years and try to say something about the lessons that I think the bank has learned. Okay, so that's the agenda. Let me start with a model and let me report on the Bernanke-Blanchard model. So for those of you who don't know, Ben Bernanke was chairman of the Federal Reserve in the US, very eminent Nobel Prize-winning economist there. Olivier Blanchard, an equally eminent economist, French economist, mostly resident in the US. They've come up with a model which I found rather helpful. And we've implemented this model in the UK, along with Josh Martin, who is sitting over there, and Leonard Brandt, who is sitting over there as well. And this is part of an effort across other European central banks to implement this model and see what the answers are. Let me walk you through how this model works. And again, to try to give you some sense about how it is we answer the questions that I put up on the slide just a second ago. So the first point is to think about the wage bargain and think about firms and workers attempting to settle upon wages. What will wages plausibly depend upon? Well, they'll depend upon past wages. Workers will have some reference point in their mind. Workers will want to settle wages based on expected inflation to make sure that they're adequately compensated for any changes in the real economy. And then they might be looking also at past inflation as well. The condition of the labour market, if the labour market is tight, that puts workers in an advantageous bargaining position. And of course, productivity is at the heart of the general long-term trend in increased wages. So that's where the productivity issue comes in. What about prices? Well, what's the relationship between wages and prices? Prices, of course, depend upon past prices. Firms adjust their prices in a sticky kind of way. They depend upon wage costs. So there's the link with a left-hand box. Firms are going to be cognizant of the wages which they're having to cover in their price setting. They depend on productivity as well. And then an important box in the current era is the various other costs that firms are having to pay, energy, food, shortages, and so forth as well. The final part of all of this is you'll see over on the left-hand side that part of what motivates wages is the inflation that workers expect. So the final element to all of this is to say something about expected inflation. What does that depend upon? Well, it depends upon, in this model, at least two things. The first is current inflation, and the second is target inflation. So think of it in this way. It's all very well the Bank of England announcing that there's a 2% inflation target. If nobody believes that target, then the weight in people's expectations formation would be rather low on target inflation. And they might, for example, say, well, inflation's currently running at whatever it's running at in the height, around 11%. That's what we expect inflation to be. On the other hand, a kind of anchored situation where what economists call the well-anchored expectations will be one in which people ignore the current inflation but have some confidence that the bank is going to restore inflation back to 2%. So that will be a situation in which most of the weight in the expected inflation process is on that second point here around target inflation. Okay, so that's how the model works. That's the sort of conceptual idea. Then we take the model to the data and try to estimate all the various interrelationships. So that's what I mean by a model. Again, for those of you who aren't familiar with that language, it's the various interrelationships between that which we're going to calibrate in the data. We're going to do this for the current day, and we're going to do this for the 1970s as well, again, to try to answer the questions that I was saying earlier on. Okay, let me just take you through the model so you can see how it works under the heading of first round effects and second round effects. So what are the first round effects? First round effects, think about a rise in the price of energy. What does that do for firms? Their costs go up, and that feeds therefore back in the next stage into past prices, and that feeds into the inflation process. The adjustment of prices is sticky, and so an increase in prices has some natural momentum to it when there's this sticky kind of adjustment. So that would be what economists call the first round effects. The second round effects bring in the rest of the process. and they do so in the following kind of way. Let's think about the energy price shock again. If energy prices go up, then current inflation goes up. That's just kind of mathematical, essentially, because the inflation basket includes energy costs. If current inflation goes up, then expected inflation might go up. You're saying, but wasn't he just talking about the targeting? Well, it'll go up to the extent that people believe that current inflation is an important determinant of expected inflation. It won't go up so much if people believe that it's a temporary blip and the inflation will go back to target. So again, you can start to see how this model is going to work. Once expected inflation goes up, that's going to feed back into the wage process. If you remember, I said a minute ago, the wage process requires workers, not unreasonably, to form expectations about what future inflation is going to be. So once they're expecting some future inflation, that feeds into that process. And that then feeds into the wage costs, which then feeds through into prices. So you can see that the first round effects essentially are confined to that first box, and that would be a blip in inflation. The second round effects, were they to be strong, are the whole three boxes come into play. And then you have a wage price spiral, okay? Because once those wage costs go up, then the prices go up. Once the prices go up, the expectations go up, and we go round and round and round. So you can think of this as a sort of spiral kind of notion. So I hope that makes some sense to people who are not familiar with this kind of model. Now, before I estimate the model, I'm just going to walk you through how to think about two different economies. And so this will illustrate, I hope, what I just said in words. The blue economy here is the flexible labour market. This should say flexible labour market and anchored expectations. I'm sorry, underneath that bar there, apologies, should say anchored expectations. So what does that mean? So this economy is a model economy, so we haven't done any data yet, is a model economy where there's been an increase in the price of energy, but inflation expectations are well anchored. I just said that. And also the labour market is flexible, which is to say workers treat bygones as bygones. If inflation goes up one period, they're still expecting inflation to be 2%. So they say, unfortunately, we didn't have such a good round this round, but we'll go back to our 2% expectations. So in that economy, what happens is inflation goes up, that's the blue line, but then comes down very sharply. And the number of quarters is on the horizontal axis. Essentially, it comes down after a year. So as you know, inflation is measured in year-on-year changes. So inflation just goes away after a year. The red economy is an inflexible labour market and unanchored expectations. So that's a situation in which workers, by contrast, have expectations which are going up and up and up, and those expectations feed through to the next part of the wage bargain, which feeds through to prices, which feeds through to wages. So you can see there the red line, inflation goes up, it comes down, but it keeps going. Okay, so those are the two types of economies. And then there's a similar picture here, which you can see in the paper, which responds to tightness in the labour market. If tightness in the labour market goes up during the more flexible economy, that's the blue line, and the inflexible economy, that pushes up on inflation. Okay, so that's just a whistle-top tour on the model. Let me tell you then what we actually find. So let me now go to the data and see what our message that we think is. So again, here's the picture of the blue economy and the red economy. And I'm going to start with the 1970s and the current day. And when we estimate the model and then simulate using actual data, remember this is just sort of model data, using actual data what these economies look like, we get the following picture. So I'm sorry this is a sort of jumpy line, but you'll see, I think you'll see the idea. Let's start with the current day, which is the blue line at the bottom here. This tells you what the model thinks the change in inflation is going to be following a one-period energy price shock, such as we've just had. So it's a blip up in energy prices, and then that stops. And you can see that blue line is a bit shaped like the blue line underneath there. In other words, there is a burst of inflation for a year or so, but then inflation drops out of the system. So there is not so much persistence as those high expectations, and which puts together that wage price spiral I was mentioning. There isn't so much of that. And it turns out in the data, that's what that economy looks like. The red economy is the economy estimated over the 1970s. So in other words, the red economy looks like the red economy on the left-hand side. What does that mean in words? Inflation expectations in the 1970s, the data tell us, were much more de-anchored. So the expectations that people have had inflation depended much more on current inflation. When current inflation was, 25, 30 odd percent, that raised inflation expectations, therefore set off this spiral. So the first sort of test of this model is to do the accounting between the 1970s and now. And the model looks to be plausible. We think the model looks to be plausible in the sense that that's a sort of stylized story that people tell about the 1970s back then. Okay, so that's a bit of economic history. What about the current situation? What about accounting for the recent inflation? Let me talk you through that, and then that'll take us into policy. So what I'm going to do is I'm going to build up the slide in the following way. So sorry, this is going to be a bit of a busy slide, but let me animate my way through it. So we've got along the horizontal axis the year. So we're going to start in 2020. So kind of the pandemic was right at the end of Q1. March 2020, right? So right at the end of Q1, and that's when it really started in Q2. In 2021 was a sort of recovery from the pandemic, and you can see the black line, which is inflation. This is in quarter-on-quarter space, so this isn't quite the headline figure you're used to, but you see the idea. The black line starts to rise, so inflation starts to build in 2021, along with criticism of the bank. 2022, we were recovering from the pandemic. Shortages, this, that, and the other. And then inflation, as you can see from the black line, has started to come down. And it's back down. This model is estimated up to 2024 Q1. That's the most recent data that we've got. So is everybody with me on that pattern of inflation? So what we're going to do is we're going to try to understand what the model tells you about the causes behind that pattern of inflation. So what are these grey bars? These grey bars tell you this. Let's start the economy off in actually 2019 Q4. So think of that as being a pre-pandemic economy and assume that there weren't any shocks and there weren't any changes in food prices and shortages and this, that, and the other. And the labour market was just whatever the labour market was. What would have happened to inflation? And this model, that very gradually rising grey line tells you that inflation would have risen rather slowly. Okay, so that tells you that in 2019 Q4, the labour market was a bit tight from an inflationary point of view. And on many indicators, that's true. There are lots of other things going on. But that gives you a sort of a baseline. So a gentle rise due to the tightness of the labour market at that time. Okay? So that's heading number one. That is effect number one. Effect number two is shortages and supply chain disruptions. This is a difficult thing to measure, but we've used a measure along with other European and American colleagues of disruption to supply chain, the various shortages that there were. If you cast your minds back, I know it's a painful period, but if you cast your minds back to the period of the pandemic, it was difficult to get things. Firms had run out of materials. There was all sorts of worries about the shipping containers being in the wrong place, etc. So what happens there? So you can see those yellow lines there. Those yellow lines are the contribution to inflation. So they tell you inflation was pushed up a bit above that grey underlying path by those shortages. So look in 2021, those shortages and those supply chain disruptions are pushing up on inflation. And that carries on in 2022. Those shortages and disruptions come off a bit in 2023 and have come off now. But according to the model, they're long enough lasting to set up a series of dynamics so that inflation persists. Okay, so that's the contribution of shortages. That's sort of candidate number two. Candidate number three is a bit more action, and that's the contribution of energy prices. So those are the blue lines. What's going on in the blue lines? So the place to look is in 2021, where again inflation is going up. And you can see that those blue lines are starting to push up on inflation, especially in 2021 Q4. And then in 2022 Q2, can everybody see those very big blue line there? Then there's a big push up inflation. So of course, 2022 Q2 is the actual invasion of Ukraine. You might reasonably say, well, what on earth was going on in 2021? Well, we didn't know it, but not that we didn't know it. There was no particular crisis, but it's just that energy prices were going up. They were just going up rather more slowly, which we now know were a preparation, somewhat in anticipation of that war. So the rise in inflation in 2021, so that again, that black line is driven a lot by the blue line. What about the current day? You can see the strong negative impact of those blue lines on inflation in the current day, which is to say the energy prices are coming down and so that's pulling down on inflation. So this is a slightly tricky issue, which economists and statisticians love about levels and growth. The level of energy prices is still higher than it was, but the rate of change of energy prices, having been very positive, is then a bit negative. Okay, so that's energy prices. That's candidate number three. Candidate number four is food. I got to say that over 2021, 2022, we were measuring the food. I say we were measuring the food price. The Office of National Statistics, for whom there are many of my friends here, were measuring the food prices. And at the bank, we were keeping half an eye on that. But the energy prices, I must say, were very salient towards us. But as it turned out, these food prices are very important. And let's see what was going on. Again, in the 2021 increase, they're not so important. 2022, look, they're particularly important in Q3. That's that blue line. And then they've carried on in their importance as well. So that's candidate number 4. And the final candidate is the tightening labour market, which we measure using something called the vacancy to unemployment ratio, which is how many vacancies out there relative to the number of unemployed people searching. You can see that red line there. 2021 Q4, that is turned out to be a bit important, and it's grown somewhat of importance as these other things have come off. What happened in 2021 Q4, again, cast your mind back to that, the furlough scheme ended. There was a lot of uncertainty at the time about the status of the labour market, the furlough scheme. But you can see that the labour market was actually, rather tight, although it's hard to measure it. And indeed, we raised rates at the end of 2021 Q4. So in terms of accounting for inflation over those times, let me summarize then. We think that the source, here's the graph again, in annual space, large and repeated price shocks. Some of these second round effects, not as big as in the 1970s, but nonetheless, the natural momentum mean these things last for a long time. You saw the shortages, the yellow bars, and a tight labour market. And so therefore, in the paper, we are less keen on some alternative explanations. One is it was the money supply which got out of control. We're less keen on that. There's a long-run correlation between changes in money supply and inflation, and a short-run correlation. The other story, which you hear a lot in European economies, for which there's a bit more evidence in this framework for European economies, is greedflation. There doesn't seem to be any evidence of greedflation here. And finally, and this is a kind of long involved argument, which I won't go into now, is the notion that the Bank of England didn't need to raise rates at all, because after all, inflation expectations stayed the same. And so you could have just let the whole system kind of wash its way through, which we don't think is the case. Okay, so let me in the last couple of minutes say something about real-time policy making under uncertainty. And again, for those of you who are interested in a little case study about how public policy is enacted, here is a minor case study, which is of great interest to me, but I hope is of interest to other people. I'm going to walk you through something called the Beveridge curve, the VU curve, and the VU curve runs like this. On the vertical axis of vacancies and on the horizontal axis is unemployment. Again, I apologize, the slide has cut that off. So this is the unemployment rate on the horizontal axis here. So at the February 2024 meeting, when we all sat down together, we had the following data available to us. We had some long history, 2001 to 2019. And you can see that relationship, essentially, it's a pretty tightly fitted, this is for economists' terms, this is a very tightly fitted line. I know many scientists will be horrified about the notion that this is a tight fit, but for economists, this is quite a good one. You see this tight fit between vacancies and unemployment. And what does it tell you? It tells you that a sort of hot economy is one where there are lots of vacancies up on the left there and rather low unemployment. And then economies essentially travel up and down this line here. When we get into a recession, the vacancy rate goes down, unemployment goes up. So we travel down that line there as well. Okay, so that's the sort of behaviour that we thought was the case in 2001 to 2019. Let me pick you through to the other data that we have. Over the pandemic, goodness knows what was happening over the pandemic. There was the furlough scheme and this and that. So I'm going to move on from that. An initial post-pandemic period is the data look like this. You'll remember the labour market was very, very tight. So an enormous number of vacancies during the recovery from the pandemic. Firms were desperate to get back the workers, many of whom had been furloughed. Unemployment was very low. And then what happened over that period as those workers started matching with the firms, vacancies started to fall and unemployment started to go up. So that was in 2023. And then the ONS had some difficulty in measuring unemployment because of response rates on the labour force survey. There's heaps of detailed information about what was going on, but you'll be aware of the difficulties which actually every statistical agency has had about measuring these unemployment numbers. So at our meeting in February 2024, we had an experimental data which looked like that. So the question in front of us is, how do we interpret those numbers? And broadly speaking, there were two interpretations. One interpretation is that the economy is just coming down a very steep part of this blue line. It's going to go back to this blue line. And once it gets back to the blue line, it's behaving as it was before. Now, why is that important? What's important to us is this. The location of the blue line tells you something about the functioning of the labour market. It tells you about how well vacancies are being matched to unemployed people, or how appropriate in some sense the unemployed are to the vacancies. If the economy returns to that blue line, it says that the matching process in the labour market is what we thought it was before. So unemployment might be, I don't know, I'll take that blue line around 5%. Vacancies, those unemployed people are relatively suitable for vacancies. Vacancies, that will be consistent with vacancies about 2.25%. On the other hand, if that red line was outside the blue line, it would tell us that the economy is doing that matching process less well. In other words, for every level of unemployment, there are lots more vacancies than they previously were. That tells you that firms are having a lot of difficulty filling those vacancies. So if you look at that red line there, it's not really quite clear. Now, if you do a bit of curve fitting, which again is what we're forced to do, the best curve using other bits of data suggested that that red line was outside the blue line. That's an impaired labour market. An impaired labour market is more upward wage pressure via the model I've just said, and that gives you higher rents. So when I looked at those numbers, I say compared with the various other numbers, I took the view at that meeting the labour market had been really quite impaired, and that made me more, I don't like these words, but that made me more hawkish, inclined to vote for a higher rate. That's that at the February 2024 meeting. So let me reanimate the slides here and just repeat exactly what I've just shown. I've taken away the pandemic era. Now let me show you the data that we had at the following meeting, and that was the revised data, and those were the green numbers. So the ONS revised the unemployment numbers there, and what looked like that red line in unemployment turned out maybe unemployment was coming back down again, maybe it was going up again, we weren't quite sure. But with those types of uncertainties, that green line, again, if you sort of make a fit through the green line, and again, using lots of other data, that makes you think a little bit more that what the economy is doing is it's heading towards the blue line. Do you see what I mean? That there's a bit less impairment than before. Again, I stress, I know when you look at this, you think, oh, I could fit anything there, but there's various other bits of data that we're using here as well. But I hope it can give you the sense. So deciding where the economy is this delicate interaction of all these various lines. And as I say, this was a real world application of how just in a month, the interpretation of how the economy was going changed. Let me, in the last couple of minutes, just move on to some prospects for inflation in the following way. What we do in the paper is we go back to the model I've just described, and we try to say how much of the current wage inflation is due to these second round effects. That is to say, this additional process of expectations and so forth, just to try to shed light on what's going on in the economy. And what we do sort of schematically here is we turn off these various effects here. So we assume that inflation expectations are anchored, and we turn off the effect of wages on expected inflation and so on. And what do we get there? We get the following. So this is the outturn of wage growth up to 2024 Q1. Here's what the model predicts. So this is the sort of full model. And if you turn off those second round effects, you get this gap, which is to say that these second round effects are pushing up a bit on wage inflation. So there's a bit of that in the paper. Let me, Rebecca, get to the final slide in this case and walk you through some of the conclusions. So firstly, about the past, the pandemic era inflation, as I've mentioned, price shocks, second round effects, a tight labour market. In my view, the bank was not behind the curve. ESCoE, let me advertise all the good work that ESCoE do. For those of you who aren't familiar, ESCoE is the Economic Statistics Centre of Excellence based here. They work with the ONS to try to improve the data, try to improve the measurement. I hope even if you've been a quarter listening to what I've been saying, how important measurement is with all of this and how we're just trying to do all this stuff in real world with noisy data and so forth. So I applaud ESCoE's efforts very strongly in helping us to do all of that. So that's on the past. About the future in the near term, again, I repeat what I said before, the labour market is tight, second round effects are playing out, and hence my view on the bullet point there. Finally, saying something about the more medium term. So here, if you'll just forgive me, having done 6 years, we spend so much time worrying about the next interest rate setting, what the market thinks of what's going to happen in that few weeks' time. If you'll forgive me the luxury of just reflecting on a little bit more medium-term issues. What's crucial, I think, behind all of this, hanging over all of this, is central bank credibility and trust, which I think of, of course, as being an intangible asset because I work on intangibles. So what does that mean? Like any other asset, an asset needs a bit of investment in order to keep its level high. How do you invest in trust? Well, fortunately, the political scientists here at King's are very interested in this subject. So I've stolen a bit of intuition off them, which I think is helpful. This is a 3-stage framework about investing in trust. Trust requires the following, according to political scientists. Firstly, something about integrity, that trustworthy institutions, in order to gain trust, have got to stick to their promises. I think independence is going to be important. Part of the reason we think independent central banks will bring inflation down is that they stick to their promises. Maybe other people won't, but it's not the only thing you need to do. Ability is the second issue, which again the political scientists say is important for trust. And obviously that's something about competence. If you read the Bernanke report is full, quite rightly, of detailing the terrific staff and the talented PhDs and the very good work that's going on in the bank. I have to say, though, that if you ask external people about the competence of the bank, they probably just say, well, aren't you just missing all of your target inflation? Isn't inflation very high and you can't forecast it? So how does that impinge upon our view about confidence? Well, there's something about the Bernanke review I think would help. So those of you who know, in a separate piece of work, Ben Bernanke has done a review of the bank's forecasting processes. I'm hopeful that his recommendations about the bank doing more experimentation and doing more scenarios will help people understand about the competence of the bank, the wide uncertainty that there is, and the work that the bank is doing to try to improve that. The final part that the political scientists tell us is important is something about benevolence and around intrinsic motivation. I have to say that most people, I would guess, view of intrinsic motivation is based on whether people think you're a hawk or a dove. If you'll forgive the personal note, when I first started, I was an uber dove. Now, apparently, I'm an uber hawk. That shows you, it seems to me, how unhelpful these labels are, because what we're really trying to do is we're all trying to hit the target. How are we trying to hit the target? We're trying to hit the target by using, I hope, good models and interpreting the kind of data which ESCoE is working on. And by carrying on doing that, then I hope we're going to build the trust that central banks need so we can get away from the hawk and dove interpretation. I will stop there with that overview and pass back to you, Rebecca. Thank you.
Thank you very much, Jonathan, for such a clear exposition of the effects of recent events on inflation. And I think your talk also illustrates very nicely the importance of official statistics and their role as critical infrastructure supporting the policy process. So we now have time for some questions from Jonathan. So if you would like to ask a question, if you could please raise your hands. We have a roving mic over here. We've got till 18:15, so if I could ask you to please get to the point, and if you could start by giving your name and also your affiliation. So I think we'll go straight here.
Thank you for the talk. Pardon me if this is a bit naive, but you can have the best model, but if your data is not real time and accurate, then you will still make a wrong prediction, right? So it seems to me that you said that the labor market data for February and March is it's not as expected. So isn't there more efforts that you need to do with like some proxies? So for example, like LinkedIn and kind of or like looking at other jobs market and kind of classifying, say, contract work, permanent work, and kind of seeing if there's any kind of like white collar recession, blue collar boom kind of effects going on, because then you would see that, disposable income and kind of the effect of that. And also there's also a circular effect of the interest rates to the housing costs, which is a big part of someone's income. And so then what you would expect to be like a wage kind of growth is an effect of, because their costs are going up, which is a circular effect of that interest rate. So how are you considering these factors?
Thanks. We'll get a collection of questions.
There's a question here.
Thank you, Jonathan. Matteo Bartra from Imperial College. I just wanted to ask, looking back in your last 6 years, is there any instance, could you reflect on an instance where you made a decision on interest rates that was that you maybe regret now, and it wasn't due to uncertainty?
Thanks.
And take the final here.
Thank you, Jonathan. I'm an equity research analyst from Investors Edge. I just wanted 2 questions, if I may, very quick. The first one I wanted to ask was, so obviously you mentioned about the lagging data and the supposed unreliability of the 3-month lagging unemployment data. You can obviously look at, for example, PMI surveys and the KPMG jobs vacancy reports. How often does the bank use this as a form of, indicating, the future of employment and the vacancy ratio? The second one, a little bit of a tangent, but obviously the markets have taken Labour government quite positively. How do you think this has impacted or will impact the risk premium to gilts, and as a result, the rate outlook going forward? Because lower gilts could mean lower mortgage rates and then higher spending and sticky inflation. So is that going to impact the rate outlook and moving forward to 25 as well?
Okay, great. Thanks for those questions. Let me take 2 questions, and then if you don't, can I park the lessons for the whole 6 years question to the very end somehow? That seems a bit more appropriate. You're absolutely, so both of these questions asking about our use of data. I've just shown you some partial data. Of course, we're using way more data than this. In particular, you mentioned, and you're quite right, about the labour market data. There's been a bit of a revolution in data. You can get pretty much near-time vacancy data, for example, from these various vacancy aggregators like Indeed and LinkedIn and so forth as well. And we use that very readily. As well. You mentioned the PMI data. We use that all the time as well. I suppose, though, I'm going to sound like a terrible old fuddy-duddy, we mustn't throw all the national accounts data as well. It's lovely to do all the sort of new shiny stuff, but the national accounts data is just incredibly important. Just a quick plea for this, if I may, just to induce people into national accounts. So what most people think is they think the Office of National Statistics, or indeed any stats bureau, is the sort of ministry for adding things up. And if we just ask enough firms what their sales were and had a big enough spreadsheet, then Darren Morgan is sitting over there from the owners. Darren could just press sum and that would add everything up. So let me please repeat, and forgive me for those of you who know this, it is true that we hopefully measure the output of the steel companies, we measure the output of the car companies, but we can't add those two. Darren mustn't add those 2 things together, right? Because the steel goes into the cars. So what we have to do is we have to do the value added in the steel industry, the value added in the car, and that's very hard. So you're right about the vacancy data and all that kind of thing. That can give you plenty of real-time texture, but we mustn't forget that workaday national accounts data as well. On the equity risk premium, too early to say. Good question, but too early to say. Oh, yeah, thank you, yeah. So the way I interpret that is what we need, and that's why I tried to show those 3 panels, is to try to think about the interrelationships in the economy. So I think most people are quite good about thinking about the relationship from one variable to another, but the feedback relationships are what I hope models are better able to capture.
Chris Giles from the Financial Times. I had two questions. One is internal to your model, which is, to what extent do you think that the parameters of the model are actually state or time contingent, so that in a high inflation episode, actually the economy works rather differently from when you actually estimated your model? And secondly, outside the model, there's now a growth industry in these inflation accounting models. The IMF have done one, the BIS has done one. There was one at Sintra last week, and there's the Bernanke Blanchard one. They all give entirely contradictory results. Why is yours better?
Charlie Bean, LSE, and formerly Bank of England and OBR. I want to probe you on your dismissal of money supply. Clearly, it's not the case that this inflation episode was simply a case of too much money chasing too few goods, naive, purely monetary driven story, which, to coin a phrase, I think is absolute tripe. But there is a more subtle version. The Bernanke Blanchard decomposition just looks at the wage price nexus. It's a partial equilibrium story that doesn't really say what's going on the demand side. And what I would assert is that had the past path of the money stock being different, which itself was a consequence of a mix of the government's fiscal decisions, furlough and so forth during the pandemic, and also the bank's quantitative easing program, that basically if the money supply had been much lower, that in the face of the external shocks that you talked about, which are the key drivers, we would have seen a different combination of inflation and output. And in particular, output would have been lower, unemployment higher, but inflation would have been lower. So I don't think it's right to simply dismiss the money supply as not part of the story. It's there, but it's there in a permissive way. And it then raises the question of, well, would you have preferred a different mix of inflation and activity from what you actually got, or was what you ended up with actually pretty much optimal given the shocks that happened?
Should we take one more?
Yeah.
Tomasz Wiatek from T. Rowe Price. So when I look at the two lines where you sort of infer the second round effect, so basically the model with and without second round effects, you know, this model has been sort of developed for the US, but if you look at the two lines diverging, they seem to be diverging at a time when the UK labour market is experiencing a very big structural change, meaning the transition out of the EU and the transition to a new migration regime. And you would expect the labor market to be less efficient during that time period. I mean, as it sort of transitions to a new equilibrium level of external, internal labor and so forth. So I'm wondering whether what you call second round effect is actually just the transition of the UK's labor market away from the EU and towards a new migration regime.
Yeah, thanks very much. Those are three terrific questions. Let me take them in reverse order, if I may. I think you're right. I mean, it's on the labour market question. I mean, a major question in front of us is trying to interpret these very noisy labour market data in conjunction with the real-time other indicators that we've got as well. And in particular, the stresses and strains from Brexit and also from the pandemic. Now, as is well known in the UK, inactivity has gone up very sharply in the UK. And I think that's part of this emerging labour market picture, where the labour market, at least in the UK, looks more and more impaired to me for a set of pretty complicated reasons, of which the pandemic and Brexit are two hypotheses. But again, from a practical policy point of view, we want to interpret all this stuff and then pass it through the various models and try to work out what the appropriate policy response is. So I mean, it's a bit of a non-answer really, which is all this stuff is very difficult, but we're having to try to process all these information. But I think something structural is going on. To Charlie Bean's excellent question. You're right, Charlie. We, you know, I was, you know, in the presentation, I was skated over things a little bit. We tried to be a little bit more careful in the text. But you're right, this is not a model. So this is a model where the VU ratio, the labour market tightness measure, is just sort of carrying on. We take those data from the ONS. But behind the VU ratio is the state of demand, how much firms want to hire people and all that kind of thing, which is the joint impact of all those various other things. I guess the tricky question is, how much difference in practice would it have made in the face of the enormous shocks that we had? And I'm not sure, well, okay, I'd have to do some accounting there. I'm not sure how much difference it would have made because these were just gigantic shocks to food prices and oil prices and the whole series of them. So the different sort of policy framework. But no, I am open to a more nuanced interpretation of what's behind all of those pressures. And then lastly, Chris Giles's questions. I think, yeah, this is fundamentally, Chris, state time contingent. That's right. And in some sense, the stuff that we've done on the 1970s tells you that the coefficients in the model. So again, sorry for those of you not familiar with how these models works, but the various responses that you get in the model look rather different in the 1970s to how they look in the 2000s. How exactly we interpret that? Is it central bank independence? Is it the, you know, different alignment of trade relationships and all that kind of thing? We're not there yet, but I think those changes are consistent with some story about the importance of credibility. And then finally, on your question about why is our model better than other models. So I've been trying to follow these various other models. Can I recommend Chris Giles's Wednesday central banking blog, which went through, if I remember the last one correctly, all these various models there. I need to read in more detail what the BIS model, the Bank of International Settlements model that you were writing out about as well. I suspect they've just got different ways of looking at these different expectations and doing different ways of accounting. But I need to do more on that to answer that question.
I have a question here. For
Yeah, Bernard Casey. I wanted to come back to the beverage curves that were put up. And I'm interested in for two reasons. I've been doing work on the beverage curve in relation to labour market changes over the last few years. There's a measurement issue, it seems to be here, and there's an explanation issue, which I'm interested in. And this is something which a colleague and I have written about, and it's about to be published. One of the things is that the measurement of those vacancies and the unemployment, certainly by the last period, have got very tricky indeed. And although you were happily saying that you've got sort of very good real-time data, I mean, in fact, the very good real-time data might be very good, but was measuring something different. And the measuring, so that was a measurement issue which the ONS was worried about, very much so. But the other issue was, and you didn't comment upon it, but I wonder whether you could comment upon the purple squirrels argument, because the purple squirrels is actually what is pushing the vacancies up, and the people are seeking sort of rather over-optimistically posting anything with little expectation of being able to fill it, desperate, because they're aware that the future might be different. They're aware that there are needs. And so the purple squirrels, I think, and that's what people in the Fed were saying, or bits of the Fed were saying, was possibly rather important here as well as in America.
what's the question about this?
Thank you, David Robinson, Market News. On Ben Bernanke and inflation expectations, he firmly recommended that the bank put in the bin this idea that in the model, inflation expectations converge back on target. Do you have any ideas as to what you should replace that with? And how are you getting on in implementing some of those recommendations?
Martin Wheel from King's College. A couple of points perhaps rather, or question first. With the vacancies data that you get in real time, how do you address the issue of multiple posting? which I might think has gone up quite a lot over the last few years. The second point I wanted to make was an observation. If you compare the inflation forecast error for 2022, looking at the error against forecasts made in mid-2021, it was very similar to the 1974 error for forecasts made in 1973. The difference was that in the subsequent years' forecast, inflation was expected to come down rapidly. I agree with you because of the anchoring effect in the recent inflationary surge, whereas in 1975, inflation was expected to come down, at least by the National Institute, and it didn't. Thank you.
Can you take one more of that? See, that lady is right there.
Thank you. Jill Leyland, I'm retired, but I work with the Royal Statistical Society on inflation measurement. Two questions, if I may. You made a very good case that the Bank of England wasn't asleep at the wheel and that it was external shocks which caused it, and I wouldn't disagree. Nevertheless, we had a prolonged period of very low, abnormally low in historical terms, interest rates with a consequent shock. And those low interest rates almost certainly helped push house prices up and possibly other assets as well. So I wondered whether, with the benefit of hindsight, you felt that might have been a bit of a mistake. And secondly, now CPI is a good inflation target, apart from one point, that it doesn't include owner-occupier costs. There is CPIH now, which includes some with rental equivalents. Now, I appreciate, obviously, it's the Chancellor of the Exchequer who says what the target is, but I wondered what your personal view was on whether CPIH might replace CPI.
Thanks. Look, thanks for all these really good questions, but given the time, I'm going to try to answer them really quickly. So I apologise to the questioners. This is just to allow others to get them in. Lots of questions on the measurement of vacancies. I defer to Mike Hogan is here, Darren Morgan is here on that. My understanding is that on the real-time vacancy data, they do control for multiple vacancy posting by telling the machine essentially to read the vacancy posting. So I think that's covered. The vacancy survey is different. It's a company survey from the labour force survey. So the travails of the labour force survey don't apply to the vacancy survey. So I set a bit more weight by all of that. David, you asked about, in general, about Bernanke and how those reforms, I mean, those reforms are ongoing, is the answer. New models are being developed. There's a whole new process working. Claire Lombard-Delli has just replaced Ben Broadbent, but she came in on Monday. That was her last week. That was her first day. So I wouldn't expect too much because we've only been going for 7 days. But knowing Claire, once it gets to 9 days, there'll be plenty of action behind all of that. Thanks for the question. Martin, thanks for those observations. Those are fascinating. I didn't know about those 1970s predictions. On the issue about, Jill, that you asked about low rates. Well, I think the low rates of that era were probably because the world just had a very low, it's got a horrible name, R star, the kind of natural rate of interest has become very low. So they were in line with all of that. On the issue about what target we should use, I believe I'm looking at other Bank of England NPC members. I believe the contract says we're not allowed to talk about the target because that's just entirely a matter for the government. And there are skilled ONS people who you could talk to afterwards about CPI and CPIH. So I'm going to defer to them.
King's Business School and ESCoE. I'd like to ask the very fascinating demonstration of the effects of different shocks on wages and prices. What do you think those shocks were doing to the Phillips curve, the key transmission element that connects the interest rates that the Bank of England controls with the economy?
Hi, David Milliken from Reuters. Just a question as to what it means in practice. What does it mean in practice for sort of inflation to sort of come down sort of sustainably? And is that sort of equivalent to sort of essentially that sort of VU curve looking like it was sort of before the pandemic? Is that sort of what would count as sort of inflation coming down sustainably, or is there rather more to it?
That's answered, Jack.
Thank you very much. Jack Meenan from Barclays. And thank you, Jonathan. So there are two things in your model that can kind of drive the second round effects, I guess, catch up and changes to inflation expectations. I wondered what do you see as the balance between those two? And to the extent that it's the inflation expectations, does that imply that at some point over the last few years, we've had a kind of a strain on central bank credibility, given that that seems to be the mechanism you outline for second round effects coming from inflation expectations? And to what extent do you think that is now reinstated, that the central bank with inflation back around target is credible again?
Okay, great. Sure.
David Smith, Sunday Times. Jonathan, excellent talk. Thank you very much. Economists tend not to like price controls. We saw the impact of a price control on inflation in the UK during the pandemic period, which was the, if you go back to August 2022, the bank expected that inflation would peak at between 13 and 14%. Many outside forecasters thought it might go to 15 or 18%. And then we saw Liz Truss of blessed memory introduce the energy price guarantee and take out some of that peak in inflation. I just wondered if more of that peak in inflation had been taken out and been taken out earlier, as you say, the second quarter of 2022 was the big one. Would that have made a big difference to second round effects, do you think, and the eventual outcome?
Thank you. Those are some terrific questions. Paul, in terms of shocks to the Phillips curve, we've got a sort of Phillips curve mechanism. Sorry, this is going to be a slightly techie answer, so I apologize for those who aren't deep into this literature. We've got a sort of Phillips curve mechanism here, but rather than Phillips curves, which are generally about wage inflation, unemployment, this has got the VU ratio in it as well. So it's a sort of slightly different interpretation of that. It's all linear, so it mimics the non-linear effects in the Phillips curve, but I think gives more economic intuition for those non-linear effects. So apologies for that impenetrable answer to the non-economists in the room. David, I think you asked about what more sort of certain and more sustainable would look like. So certainly if we had a non-impaired labour market, in my personal opinion, that would get us back more sustainably. But of course, we're looking at other indicators besides just the position of the beverage curve, and we set those out in the minutes, as you'll know: service sector inflation, wage inflation, the position of the labour market more generally. And that is essentially, so here let me echo my excellent colleague Hugh Pill, the chief economist. That is essentially a kind of a low frequency objective, which is to say, these are sort of long-term trends which evolve rather slowly, these underlying trends. And so we need an accumulation of data to look at all of those. Jack, you kindly asked about the balance between the catch-up effects and the expectation effects, and you're right. Those are the two effects which are kind of pulling in different ways. We had a phone call with the ECB last week on how to decompose all of those. So I'm looking at Josh and Leonard, who are the great experts, and they will be able to write to you and tell you what the answer is with all of that. We've got a procedure for doing all that. So sorry, I can't have a better answer. David, thanks for your question. I'm not at all fond of price controls, I must say. I guess natural gas price controls work reasonably well because natural gas is natural gas is natural gas is natural gas. But I must say, one of the great benefits of this job is you go around talking to firms all the time. And if you ask firms what do they produce gazillions of goods, right? So quite what a price control on, I don't know. So we were at a company making cigarette patches the other day, nicotine patches for people, and they make a huge variety. So how you control those prices, I do not know. We could simulate the model to find out how much more or less of the headline rate would have affected the various effects that we described. So I don't quite know the answer to all of that. In general, I think the message of the model is that these effects work themselves out reasonably quickly. So it may not have had a very big effect, but we need to go back to the model. Could I end by answering your question, which is a more medium-term question, where I think you asked, is there a decision that I've regretted? I don't know. I think one of the funny things about monetary, but not one of the funny things, but it's not funny at all. One of the difficult things about monetary policy, I'm sorry, many people have very difficult jobs, so I'm not complaining about our job, but one of the, within its own definition, one of the difficult things is this. there are, as the famous Friedman quote, long and variable lags to monetary policy. So when you make a decision, probably 18 months later, that decision takes its effect because of the way that it works through the economy. And you've seen those pictures that we saw earlier on. So what we'd really like, to answer your question, is to take a decision, and we all have different views, and then nothing happened to the economy for a year and a half, and then we'd be able to figure out who was right, and then we could give a gold medal to whoever it was and a wooden spoon to whoever is at the bottom. But unfortunately, that never happens. So one of the, as I say, interesting and difficult features about this job is you never actually know whether you're right or not. Whether I regret the decisions is a kind of difficult question to say, because I never actually know whether I was right or wrong in the first place. So in a funny sense, there's no room for regret. And I don't mean that in an arrogant way. I mean that because it's just genuinely difficult to figure out whether the decision you've made is right or wrong at all.
May I just follow up? I was looking for an answer about if you thought, okay, maybe I didn't consider some parts of the data or some aspect of the economy. It was available, but you just didn't consider it.
Well, so we always want to consider more data, but we've got limited amounts of bandwidth. But again, because you can't do that control experiment, then I think it's impossible to sort of form that view. And the economy is changing all the time. So that the other part of the answer, I think, is, I don't know how others in the room who've done this as well, is you actually just don't get any time or bandwidth to ever look back. This is the only occasion where I've ever actually had the time to look back. So just for 2 minutes, I've been looking back. But otherwise, you're keeping on going the whole time, so you tend not to look back.
Thank you very much. Thank you, Jonathan, all of us.